Hello, members, one and all of the Salivation Nation. The market will one day implode. Yes, there's been a sort of a recovery after this quite volatile market we've had for the last few days. The markets have kind of recovered, at least for now. But Carl Icahn, who is known for his investment savvy, the stock market has been around for quite a long time. In fact, there's something named after him when the prices are low called the Icahn lift. Well, there's a piece here on CNBC that talks about Carl Icahn and his gloomy prediction for the market because of these wacky funds using so much leverage. So it's quite interesting, something to pay attention to. We shall see if his prediction is correct. But the bullet points here says there's too many exotic leverage products that one day these securities are going to blow up the market, Carl Icahn tells CNBC. And the market itself is way over leveraged and at some point could implode. But for now, he believes that it will probably bounce back. So the short-term prognosis is that it's going to bounce back. And I tend to agree with him, at least for the short term. So billionaire Carl Icahn told CNBC on Tuesday there are too many exotic leverage products for investors to trade, and one day these securities are going to blow up the market. The market is a casino on steroids with all these exchange-traded funds and exchange-traded notes, he said. These funds, especially the leveraged ones, are the fault lines that will eventually lead to an earthquake on Wall Street, he said. These are just the beginnings of a rumbling. The latest example is an obscure security designed to be a bet on the calm market that's being blamed for causing an influx of selling in recent days. The Velocity shares a daily inverse VIX short-term exchange-traded note, XIV, blew up overnight as investors were forced to sell when the market went haywire, also known as the Velocity Index, or as a result, Credit Suisse on Tuesday said February 20th it will end trading for its XIV, which was supposed to give the opposition return for the COB Volatility Index, also often referred to as a market's fear gauge. And looking at it, we can see where it is now. It was 50 there, SPX, and down 7 for the VIX, and all these different measures there for the 3 VIX futures above there. Very interesting. So the market itself is way over leveraged, Icahn said on Fast Money Halftime Report, predicting that one day this thing is just going to implode. He described the possible implosion as maybe eventually worse than 1929, making reference to the stock market crash that contributed to the Great Depression. The market has become a much more dangerous place, he said, adding that the current volatility is a precursor of potential trouble. It's telling you something, giving you a warning. Investors are piling into index funds thinking they'll never go down, Icahn said. Passive investing is a bubble right now, and that's a great danger. But as much as he would sounding the alarming bells, I don't think this is the explosive time. The market will probably bounce back, he continued. I don't think this is the beginning of the end. The stock market entered its third day of huge sell-offs and volatility on Tuesday, a day after plummeting 1,600 points. The Dow Jones Industrial Average opened lower, plunging as much as 567 points, and dipping into correction territory before quickly swinging 367 points higher, and has since recovered even more. Icahn, an activist investor who often pushes for changing struggling companies, was an early supporter of Donald Trump for president and a confidant during the 2016 campaign. The chairman of Icahn Enterprises later became an advisor on regulation to Trump, but resigned in August, facing criticism over his role in an energy firm seen as a conflict of interest. Shortly after the 2016 election, Icahn said he left Trump's victory party early to take advantage of the market dip and bet about $1 billion in stocks. Wow, I guess that would be worth leaving the party early, eh? Icahn, who has been investing in the market for 4 decades, reflected on CNBC Tuesday about his election night buying, saying it was obvious that Trump would get rid of regulations that hamper businesses and market would eventually respond positively. That's known as the Trump bump, and I do believe it was a real factor. But even with 3 sessions of intense selling, the Dow and S&P 500 were up about 32% and 24% respectively since Trump won the presidency. And that's just it. I believe that this Trump bump and the what I call real market response to real activity in the economy is on top of an artificial inflation. And no matter what's the foundation or where it is, it's overvalued, and because of the leveraging and the like. And so I can understand why he would make such a gloomy assessment. However, I hope it's not the case, and I do think that with as much as with the markets being the way they are, and electronic trading, and some say that there was essentially automated and number selling, and that's what participated in it, that it could continue in that regard and recover just as quickly. And I think that's part of what we saw with the recovery today. And so I think, with the biggest bounce, these big bounce backs and dips, and then that doesn't necessarily mean it's the end. And I think Carl Icahn sort of alluded to that, and why he doesn't think this thing is going to crash right away or implode. Could it implode? Well, that's a good question, and I don't think no one really knows. I think Mr. Icahn might be more with his 4 decades of experience, probably has a better pulse on this type of thing than the average layperson, certainly me. But regardless, we hold precious metals. And those precious metals, I believe, are what's going to protect us in such a time if the market were to implode. And but how important is the market? What about the economy? What about these other factors? Main Street and Wall Street are very, very far apart from one another. And all the activity that happens in between certainly does play a role on both sides. But I believe that we are positioned as holders of precious metals, gold and silver, to protect ourselves in these cases if there's if there's an implosion of the markets and the like. It'll be quite fascinating to see where things go from here. What will tomorrow bring with the markets? They could swing back the other way just as quickly, or they could soar right back up again, and this could have just been a blip on the radar. And as time moves, we see the markets go back to right where they were, and these last few days will just be a distant memory. That's just it. We live in an information age, and the 15 minutes of fame have essentially turned into 15 seconds of fame. From one news event to another in a 24-hour news cycle where things are changing so quickly and rapidly, one news story is on top of another. And that includes in the financial markets as well. And that's why I think that a lot of these hits and these happenings, even when the Federal Reserve Chair speaks, one word that can cause the markets to react, as it did with Janet Yellen in a video I posted previously, very quickly can the next word or somebody else say something else that pulls it right in the opposite direction. It's quite interesting and fascinating how quickly things can change. And but overall, things are up and up with the economy, which is good news if we can move in this direction and move forward. But the long term, and how much more can we go with doing the things with leveraging and the like before it bites us, just like it did with the housing market in 2007 and 2008. We are overdue for a recession. They say the average recession occurs about once every 8 or 9 years. We're overdue for one. And there's a lot of the same kind of practices that were in place before the prior recession. So It's anybody's guess. We shall see, but we'll be prepared because we hold gold and silver. Hope you enjoyed this video. Post your thoughts below. I'd like to extend the multitude of gratitude y'all for watching and encourage you to please rate, comment, and subscribe.